Hey, what's going on, guys? Today I'm going to talk about some various high income funds that have begun to get a lot of popularity over the last year and a half. I'm going to kind of show you what I'm doing and what my plan is with these funds. So let's go ahead and look into some of these here and kind of talk through my thought process with them. So this is one of YieldMax's biggest. I don't know if this is the original one they created, but it's ticker symbol TSLY. It is YieldMax's Tesla Option Income Strategy ETF. You know what they're doing? They are going out and selling call spreads, synthetic call spreads. So they don't own the underlying of Tesla, but they are selling call spreads to pretty much generate a high income, for their investors. They're also holding some treasury notes. It does look like they're actually, it looks like, if I'm understanding this correctly, looks like they may be selling like a put spread or some type of spread on the put side, maybe to generate some premium, to then also be able to sell some calls. So I'm not 100% sure of how they're using the puts here. Looking at their objective listed here, the investment seeks current income. The secondary investment is to seek exposure to the share price of the common stock of Tesla, subject to limit. Obviously, they're limiting their upside, so they're limiting the potential investment gains. The fund will employ its investment strategy as it relates to Tesla, regardless of whether there are periods of adverse market, economic, or other conditions, and will not take in temporary defensive positions during such periods. So that is one thing that is something concerning to me. I like to have control over my investments, and with that being said, right there, it's saying that the fund is going to behave a certain way, regardless if it is quote unquote the best market or best timing of things. Obviously, if Tesla drops 30%, right? If there's a huge sell off, it's going to continue to sell call spreads. So you're going to participate in that huge drop, and then it's immediately going to continue to sell call spreads at the bottom. So whenever Tesla does recover, if it does recover, you're going to be limiting yourself significantly. So what that means is Tesla's going to have to recover much more than what it had dropped for you ever to kind of get that back, pretty much what you lost there. So that is kind of why I, prefer to have control over these types of trading strategies. Obviously, it's not passive. It takes work to sell spreads, to manage positions, but they almost mentioned in the third or fourth sentence there that regardless of adverse market, economic, or other conditions, it's going to continue to do its synthetic covered call position to create income, whether that's the best move or not. They don't really care. They have one objective, and it's to continually create income, regardless if it's the best move or not. So that's one con that I see. Just quickly looking at that, the performance. Obviously, these funds are going to correlate somewhat with the underlying. Obviously, Tesla's been getting smacked, so Tesla's not going to perform as well. But if you look at something like NVDY, it's correlated to NVIDIA. NVIDIA has been on an absolute tear. So with that being said, NVDY has been doing a little bit better than Tesla. So it's up 125%. So pretty sweet there. However, if you would have invested into NVIDIA over that same time period, you would be up significantly more. So, that's just something you have to consider. These funds will, in my opinion, underperform the underlying asset long term. Maybe not short term, but I think definitely long term. They are going to underperform, which is fine. If you're okay with that and you're willing to give up that return. But just understand that and act accordingly. So NVDY, It's currently paying an estimated distribution yield of 63.85%. So very large yields there, and this is why a lot of people just love these and are getting so obsessed with it. And totally, rightfully so. People, these yields are just very high. With that though, you have to understand, with having these high of distributions, there's going to be some NAV erosion. So just keep that in mind. They, from what it sounds like, they're not keeping anything back. They're distributing pretty much almost 90% of their earnings from the options premium, whereas some other funds don't distribute all of it. Yield Max is fund managers. That is kind of their philosophy there. They want to distribute everything that they have or everything that they've made to their investors. So pros and cons with that. So this is one of the higher yielding ones. I don't know. This is on Fidelity's platform, so it's not the greatest for some of the data I'm looking at here, but this is kind of cool. So I don't know if the inception date was December, but it looks like if you would have invested $10,000, growth of hypothetical, so it looks like it, more than 100% return over a year. So that's it's pretty good. NVDY I think is at over 200%, but yeah. So that's another example. I know another one that's getting a lot of popularity, and it's these round-tailed funds, QDTE and XDTE. The reason everybody's flocking to these, there's only 128 million, but these are definitely probably growing very massively right now. How they differ from Yield Max is they pay weekly versus monthly. So a lot of people are very interested in that. Needless to say, it's ultimately going to be, in my opinion, roughly the same distribution. They're just splitting it up on a weekly payment schedule versus a monthly. I know with some other funds, it used to be dividends used to only pay once a year, but then they went to quarterly, and now, even more. There's some at monthly, and then even a further step than that is weekly. One con that comes to my mind is that the expenses might be a little bit higher because it's going to take more work for them to, distribute weekly payments versus monthly. So that's just something to keep in mind there. And then if we look at, so it's not going to tell us the yield, but the thing that people are liking about this fund so far, it seems to be holding the NAV a little bit better than some of the Yield Max funds. So that's definitely very important, and people are very conscious of that. They want to be able to keep their NAV. They want to be able just to be in a position where you don't have to reinvest 100% of these distributions that are getting paid out. They don't have some flexibility there. So I'm not sure if long term they're going to be able to hold that NAV more than Yield Max, but we'll definitely be able to see there. Performance of QDTE. Yeah, so these are newer funds, so it looks like it's up 70%, but once again, take this data with a grain of salt because it's on Fidelity, so I'm not real confident with what it's reporting here. And another thing with these funds, if you have them in a taxable brokerage account, you just have to understand your taxes, tax implications with that. More distributions means more of a chance of being taxed more often. Now I know some of these funds are like return of capital. So it's something you have to just assess and kind of keep an eye out for, because I think a return of capital is definitely better than short-term capital gains or stuff like that. So just keep an eye out for that. Some people hold these in retirement accounts, but just keep in mind that because this is a big difference. Difference between before taxes, after taxes, taxes definitely could eat away at a lot of these gains here. Okay, and then the other one, XDTE. Same thing as QDTE, which is targeting the NASDAQ. This one is targeting the S&P 500. They're selling zero DTE covered calls. Not sure if we can see what all is in here. To provide current income and capital appreciation. So it looks like they're using SPX. Yeah, so it looks like this website only shows us 182% into some option of S&P 500, and they're holding some treasury bills as well. Yeah, so definitely go check out these fund managers' websites. There's a lot of content on YouTube. I really like looking at the interviews with the actual fund managers as well, because there can be little pieces of information that they describe a little bit easier to pick up on. So definitely go check those out. Really cool. There's these fund managers are taking the time to come talk to some of these retail YouTubers. So definitely go check those out. Some valuable interviews out there as well. But yeah, ultimately, what I was mentioning earlier, I don't think I'm at a point where I want to be like 100% passive with some of these option strategies. Eventually, when I don't want to be as active, it may make sense. But for now, my only use case with these funds are I've been swing trading them a little bit, because some of them, obviously NVDY and Tesla, those underlying are very volatile. So there's been some good price action with some of these funds. However, the liquidity at times can be tough. But I think TSLY is probably the fund that has the most volume. It's, I think it's roughly over 1 million. 90-day average trading volume 1 million. So there is a good bit of volume with some of these funds. So I like to day trade them, buy 100 shares. It goes up a couple pennies. I make $5, $6, $7, take out my original capital, and then just kind of leave the house money or, the profit in these funds, pull my original capital out, or, vice versa, build up a position where I'm up 50%, just from the swing trades. So then my downside is more protected. But then, ultimately, buying the underlying asset, I am more focused on growth right now. Income isn't really something I'm focusing on. I'm early in my career, have definitely some more working years in front of me. So definitely looking to build up more of the underlying asset before I start tapping into the income. Something I have been doing is kind of swing trading TSLY. Definitely not financial advice, whatever I'm doing here. This is just for educational purposes only. But I have been wheeling this stock. It's very volatile. It's a 2x Tesla. So this is a whole nother a whole nother discussion here as, whether or not you want to hold this long term or not, because there's decay with this strategy as well. You can also do it with Tesla. Tesla itself is a little bit more expensive. Obviously, you're looking at $21,000 in order to buy 100 shares of this fund versus the TSLY. But what I was thinking as well, kind of wheeling this stock, reinvesting 75% of the profit back into either Tesla, the S&P 500, QQQ, and then allocating like 10% maybe to some of these funds, just a very, very small percentage. But yeah, that's kind of what I've been considering, just kind of reinvesting the majority of the profits into the underlying assets, whether that's the leveraged version or Tesla itself, and then 10-20% invested into TSLY or something like that. Yeah, so that's just some thoughts there. Let me know what you guys think down below. I know there's a wide range of different opinions on YouTube and the internet in general, but I would love to hear some of my subscribers' thoughts. And yeah, just let me know down below. And also, if you aren't subscribed, please subscribe. It definitely helps out this channel a lot. And we also, obviously post on Twitter, and we are starting a Facebook group as well. So we're gonna start posting some content to those channels as well. But yeah, guys, that's it for today's video. Hope you liked it. Please like and subscribe down below.